Hello and welcome everyone to the Realtor Roast, the talk show where we roast real estate myths and brew up smart strategies. My name's Ethan. I'm a realtor in the SoCal area, and today I am joined with...
I'm Kelly, Senior Managing Partner and Senior Loan Officer at ACG Funding, and we have a very special guest today, Mr. James.
Hello, I'm James Chan, also from ACG Funding and Representative Mustache Mortgage.
Yeah, give us a little twirl. Show us off. There you go. All right. Thank you guys very much for coming again. Thank you for coming back again.
Thanks
Kelly.
for having me back. I'm glad to be back for part two.
Yeah,
so a lot of great, controversial, interesting topics today that we want to talk about.
Kelly has fans now. Kelly has people who want him back. so yeah, like hopefully we can start doing this a little bit more often. I feel like especially this year more than ever, we're gonna need consistent market updates.
Right.
Coming from lenders, not just realtors, but lenders in general too.
That's right.
There's so many things that have been happening in the real estate world for the past month, 2 months. And everyone has been throwing out their ideas. Everyone's been throwing out the predictions. Everyone's been throwing out what couldn't happen. And one of the biggest topics that are being talked about right now is tariffs, right?
That's right.
Based off of what you guys have, so for those of you guys who don't know, I'm sure everyone knows, but Trump is implementing higher tariffs for certain countries.
That's right.
Trying to promote independent domestic economy for the U.S. And that has given a few mixed results. It's definitely put its foot down in a couple of different industries. And today we want to talk about how it has affected real estate. Based off of the lending side, what do you guys think is happening? What have you guys heard? I know we've talked a little bit about it before we started this, but I want to hear your guys' 2 cents.
Well, just to start off here, I think it's important that we clear the air, right? The reason, as we mentioned, Ethan, right now, what's going on with what we see in the market, and even where a lot of the industry experts are, predicting, has been very conflicting, right? Just last week, just to, let you guys know, we saw a lot of articles stating that, hey, 10-year Treasury is falling because of tariffs. We see mortgage rates also falling quickly, right? Which, as mortgage professionals like James and myself, were equally confused about, right? We saw a lot of short-term volatility. Yes, the mortgage rates did move downwards a bit, but ironically today, we even saw them go up. So with that being said, I think there's a lot of mass confusion out there, that we want to clarify on exactly what's going on, despite what the reports are saying, right? So we do see a lot of conflicting data. Of course, you guys know, the most strongest indicator of mortgage long-term rates is always the 10-year Treasury yield, right? And whenever this number goes down, typically we see mortgage rates also follow suit. But we see a very interesting situation kind of breaking down right now as we speak, with how come with the 10-year Treasury kind of fluctuating towards downwards, why aren't mortgage rates dropping dramatically, right? So that's something that we want to talk about. I think it's a good point for us to help you guys as consumers also be aware of, right, that what's really going on in the back end, right? So just this week, like I mentioned, right, even with the dip in the 10-year Treasury, we still saw today, for example, rates going up, right? So we want to talk about why that is.
Yeah,
exactly,
why don't you tell us a little bit more about what you think is happening?
James?
What I think is happening is right now everything is reactionary. I'm not really sure what's happening, to be honest. Tariffs are the first time it's being implemented, and by the day, by the hour, things are constantly swinging one way or another. And I think a lot of people are seeing that in their portfolio, their stock portfolios as well.
Yeah.
Right. So it is something that everyone's dealing with, regardless of what industry you're in. And we would like to see more stability. Right now, I think it's too early to determine what is actually going to happen. It's kind of like a wait and see method because there's retaliatory tariffs coming, when they get implemented, and whether there's a pause. I think even, with reading articles, even people at the White House, they don't even know what's happening. So it's kind of just wait and see for now.
Yeah. Right. So, okay, then if it really is like wait and see, I'm sure a lot of people, especially if they're looking to buy sometime soon, right? Buy or sell sometime soon, maybe they want a little bit more direction on what they should be doing after, right? I think I remember you guys said where it's like, a lot of people can have their predictions about what's going on, what could happen after the tariffs, what's going on with the tariffs, how it's going to affect the market and everything. At the end of the day, I think most of us are pretty in good consensus that it could go either way. It could go either super bad or super good.
Right. So just to add to that, right, a lot of like the strongest correlations, as people know, with mortgage rates and what me and James look forward to every day is if there is bad economic news, right? For example, if jobs are being lost, there's not many jobs created every month, strength of economy, core inflation data. Anytime there is negative news, right? Generally speaking, we see mortgage rates also follow suit. Now, which is why a lot of people have the expectation, right? We saw the S&P, right? The stock market, huge losses, right? Which everyone assumes, hey, if the stock market, traditionally it becomes a riskier asset class, more of the investors are now going to shift to buying bonds and yields as a safer haven, right? But even with that, with us knowing that being true, we didn't see mortgage rates drop nearly as much as they should have last week, right? With the huge losses in the stock market, which is shocking, right? Where we see even news reporters getting it wrong. Yeah. Now, our investors just last week, when that huge, stock crash happened, right? That day we were very excited because we were very excited to tell our clients how much savings we could pass them. But when we priced it in and we looked at our, mortgage pricing for that day, it dipped a little bit, but not a huge amount. Mm-hmm. So that's the conflict that we have, that we deal with, trying to update, educate our clients, why that is, right? How come the data all points towards rates lowering, but yet they're still sustaining a higher level, right? So a lot of our investors, they reprice just based off of prospect of news, right? Mm-hmm. So they already told us that, hey, we already knew this was going to happen. We already baked that into considering where the pricing is. So a lot of them are being defensive or almost conservative because they know there's going to be short-term volatility. So they don't want to reprice all of a sudden and all of a sudden reprice back, right? Yeah. So part of that has to come from, I would say, the biggest fear, the biggest impact is inflation fear, right? Inflation is the number one enemy of mortgage rates. Yeah. Right. So if there's issues with inflation, the Feds are quick to say, hey, if inflation is becoming a problem again, why would we cut rates? Right. Yeah, so even the planned rate cuts from the FOMC, the Feds this year, they were originally planning at least 4 or 5 cuts. Now it's up in the air, right? Because they're really worried about inflation becoming a widespread issue, which tariffs, it seems like it's going to accelerate, right? Yeah. So on one side, we have the economic data that, hey, technically with tariffs, everything become more costly. We expect economic slowdown, which technically should push rates down. But yet, inflation data is so strong in terms of its impact on our market that it's strong enough to prevent any huge changes, in our opinion, which is why we see a lot of leaders in our space even getting this data wrong, or their predictions are wrong. Yeah. Right? Yeah. So generally speaking, I would say that's where the confusion is falling, right? It's not as straightforward as everyone may seem, right? Despite the news of, everyone thinking that mortgage rates are falling dramatically, the truth is they're not. Yeah. Right? So when are we going to see the actual impact or rates starting to trend down? It would be far to say, but I would make a prediction that it should still stay on track for it to gradually come down. Now, is it going to all of a sudden lose 50 basis points, 100 basis points within a week? I really doubt it, unless we have some ground-breaking or ground-shaking news and developments. So, like I said, all in all, it really depends on everyone's situation. you know, you can only be defensive and kind of wait to see what happens, since this is all so new to all of us.
Yeah. Yeah, I mean, I definitely agree. I think as far as like real estate goes too, when it comes down to like how it's going to affect market prices.
Market prices.
Sorry, stumbled over my words a little bit.
Right.
You know, I think we're all like the very basic stuff is known. You know, new builds, constructions, investors are probably going to take a hit from these just because most of the goods that they used in order to construct those houses are imported.
Right. So exactly, right? How on one side, right, a lot of people are optimistic, thinking that, you know, hey, home prices, they might fall, right? If economy especially starts to crash, affordability goes down, there's not as much competition to buy homes. But at the same time, we all know that on the American supply chain manufacturing, even if a lot of the things are assembled here, a lot of the parts, components are all imported. So technically that should be, you know, causing prices, the costs to build to go up. Of course, builders are not going to eat that loss for you. Right?
Yeah.
They're going to reflect that in their price increases as well.
Yeah,
Right?
exactly.
But who knows, especially with rates, if they are to sustain higher levels, that means affordability goes down even further with higher price increases, and debt is also higher to cost to borrow, right?
Yeah.
So on one side, yes, it could happen. On the other side, real estate has always been a safe haven, especially like you mentioned, even through recessions, as a proven asset class.
Yeah.
Right? That is more resilient.
Yeah, so I think James was talking a little bit about that before, how it was like, you know, when it comes to what people are most afraid of is recession, right? But through time, what has been shown to have been able to, like, you know, be more consistent or like flow through it the best has always been real estate. Mm-hmm. You want to break down on that a little bit more for us?
Yeah, I mean, for home prices, typically throughout the last 7 recessions or so, home prices remain stable, right? The only time it's dropped is during the 07, 08, 09 market crash, right? And all of that, I feel like home prices is always related to supply and demand, right? Yeah. And during that time, although the market crashed because of the bubble, and a lot of it was because of, you know, the stated income loans, right? The non-QM loans. But with that, there was also an excessive amount of inventory, right? There's probably 30 million more households now than there was back, you know, 15 years ago. But the inventory is like a fraction, like a third or a half of what it used to be, mm-hmm. right? So supply and demand. And that's where I think home prices are going to be. It may not accelerate as much as it did the last couple years, but I think it should be pretty stable. So if you're looking to stay in the home for 4 to 5 years and it's your primary home, I think it still makes sense to buy a house. But if you're trying to time the market for the perfect time to buy for an investment and saying, hey, it's, you know, maybe 6 months or 2 years, I want to flip it, then there's some risk to that, right? Yeah. I don't think anyone can predict what's going to happen right now.
Yeah.
So during a recession, typically people take their money out of the stock market and they put it into bonds, right? And that is because the stock market is very volatile. It goes up and down, and they want something less risky. They put it into bonds, which in turn lowers interest rates. And mm-hmm. with interest rates going down, more people during that time, they save up a little more money. They're more smart with their money. And then they're like, okay, it's time for me to get back into the market, right? So that's why home prices start going up, because people still are looking to buy homes.
Yeah, definitely. So let's say when it comes to home buyers, home sellers, you know, a lot of the times, especially as realtors, you know, we always hear people saying, oh, I want to hold off till buying until the market is better, or I want to hold off until, from selling until the market, until the prices go higher, you know. Now that we're in such a unpredictable state, you know, like, could we maybe try to conceptualize what those changes could be? What are some of, like, will the changes be major, minor, when it comes to, you know, whether you want to make that choice?
Well, I mean, I think the general theme and consensus has always remained the same, right? Like they all preach, which is date the rate, marry the home.
Mm-hmm.
The same applies here, right? Long term, we all know that over time, real estate's just going to perform like it has historically,
Yeah.
with appreciation. Now, the rate of appreciation certainly has slowed down, I would say, in the past couple of years, depending on where you are, of course. But generally, it's always agreed upon that, you know, in the long run, right, which is real estate game is a long-term thing, right? So like James mentioned, it really differs on strategy versus a first-time home buyer versus a frequent investor who has a big portfolio. What they do, their actions, their assessment of what properties they purchase is going to be completely different, right? And the home, most consumers, I would say right now, especially the ones looking to buy their first home or a new primary, right? That concept of, you know, date the rate is always going to hold true, right? Because especially a lot of our suggestions to our clientele right now has been to, right, purchase a home where the rate market is, a fair price. Later on, after, let's say, 6 months or a year, they can always do a rate-term refinance, right? Which we can help you to strategize to lower your payments later on down the road, right? No matter what, the truth is the market right now, with rates being anywhere from mid to high sixes on average, right? You're not going to get something in the low fives or fours, no matter how much money you put up to buy down. Well, technically, hypothetically you could, but you would have to fork over a pretty penny.
Yeah.
But rather than do that, right, we always suggest, hey, wait for the market to become more favorable. So long as you're able to continue to afford the regular payments, we can always help you strategize over time, right, of how to reduce your interest payments by lowering your rate.
Yeah.
Right? So
I think that's a good point. I want to add to that is that America is one of the few countries that have 30-year fix. Most other countries are on ARMs, which is based on their own, you know,
Index.
their economy, right?
Yeah.
So just knowing right now, if you were to buy a home and you got a 30-year fix, no matter what happens, as long as you're safe with your job, right? You make your mortgage payment, like that's going to be your highest mortgage payment forever for the next 30 years, right? If you keep that. So
Correct.
knowing that you're only going to get a lower mortgage payment as interest rates get better. Whereas in many other countries, you buy a home 5 years later, the economy is not as good. Now your payment goes up 20-30%. That's very common, right? So now you're faced with, oh wow, how do I make its mortgage payment when it goes up that much, right? And
Yeah.
it's hard to stay in that home. But in America, it's a 30-year fix, you know, so you're safe and you're protected. And
Yeah.
it can only go lower, it doesn't go higher.
I get it. So what you're saying is pretty much as long as you know that you're pretty good with your job. Yeah, that's a great way of putting it. I've never thought of it like that, where it's like whatever you buy it down as, it's probably going to be the most expensive it'll ever be. That's a pretty good way of putting it. Yeah.
well, especially with clients that we see, with as James mentioned, with the rise of the whole non-QM industry, which is the biggest trend that we've seen recently, right? With just 3 or 4 years ago, I would say in the origination business, I would say 70-80% of the volume has always been what we call agency or govy loans, right? Your full doc, Fannie Mae, Freddie Mac, FHA, VA, right? Whereas now, even among us, I would say almost 40-50% of our business is in the portfolio lending space. Now, this space is similar to, but not the same as the one that caused the '08 crash, right? But we still have safe harbors where we check ability to repay. But now it's just more in creative forms, right? And this has helped immensely, especially with clients who can't qualify full document, which is a huge amount of people now with rates being so high. They still have other options to go in. And the great part is that in the portfolio lending space, the terms are actually just as competitive a lot of times as the agency terms, right? So again, right, as James mentioned, with choosing a 30-year fixed option might be good for a first-time home buyer. You need that insurance of that cap of your
Yeah.
monthly payments.
Yeah.
Whereas investors, they can choose ARM options, give them a lower rate for the initial 3-5 years, right? But they plan, maybe the investor plans to flip it or sell later on. They don't need to wait out the full 30 years. Why would you not take the savings, right? Is the point.
Yeah.
So again, it really depends on each person's situation, and someone buying a primary is making a lifestyle choice.
Yeah.
Right. You want that perfect home, good environment to raise your kids.
Yeah.
It's not really an investment vehicle, but you can still build equity. There's also tax benefits, tax write-offs for mortgage interest, right? So it's always not a bad idea. And historically, knowing that real estate has been the safest asset class, why not? Right?
Yeah, and exactly to what you said last time, not last time, but what you said earlier, where it's like, when it comes to lifestyle, it definitely always depends on whether you're going to be buying for investment purposes or for primary. Because if you're buying for primary, and you're going to start nitpicking at the interest rates or whatever housing prices you're getting. One thing that I always like to show to my clients is like comparisons between what those big numbers are on a smaller scale. Like for all they know, they could be fighting for an extra $100 to $200 a month. And is that really worth it for the house that fits your lifestyle, where it's, let's say if you have kids, it's in their school district,
Right.
nice yard, well maintained, it's stuff like that. But then if you're like an investor, and where the numbers really do matter, even down to the last cent, especially now, maybe some different advice would have to be shared.
Right, exactly. So again, it's our job, us, to really help you guys navigate, right, and help you guys make these decisions, right, to benefit you long term down the road, right? So I would say no one can ever time the market. No one knows where exactly rates are going to be, where home prices are going to be in the next year, how much appreciation we're going to get. Is there going to be a correction? I know a lot of buyers right now are very fearful of a crash, right? They're saying, oh my God, stock market crashed 20% yesterday. How do I know real estate is not going to follow suit?
Yeah.
Right?
Yeah.
Which no one can guarantee. There always is a small chance it could happen. But I would say right now is also, an opportunity. Whereas if rates do drop, let's say into the 5s, right, in the future, we get some stability back with the tariff situation. All that's going to do is cause more buyers to come back.
Yeah.
It's going to be another bidding war feud, right, with everyone. And everyone knows what happens.
Yeah, I mean,
happens,
every buyer has to, even sellers, they have to understand, there's pros and cons in both high and low interest rate markets, If the same way that they can find a reason to never buy, we can always find a reason to always buy,
Right.
And it's really funny because the past month actually, all of the clients that I've been talking to, I've heard such mixed, opinions about what's happening with the market. Even sellers, what's happening with the market. What Trump tariffs. What's happening. Some people are saying, oh, the tariffs are hitting. I'm not gonna buy right now. Some people are saying, oh, the tariffs are hitting. I have to buy right now. So it's so much interpretation, so much speculation from other people.
Right.
Which is why I think it's really important that it's people like us who have to always look into stuff like this, talk a little bit more, find a very neutral basis of where everything sits.
Right. I mean, it's funny because this whole situation kind of reminds me of COVID. Remember right when COVID started? And there was so much fear mongering with, everything crashing, all the businesses no longer able to operate, which means real estate will follow suit, right? A lot of people were worried about, hey, am I buying at the exact wrong time? Am I buying at a high point? Is real estate going to crash for a couple years before it comes back? And look at what happened, right?
Yeah.
Once we saw mortgage rates hit record lows for the past 30 years, 40 years, the amount of price acceleration and appreciation that happened that followed suit was crazy, that it made people feel like they missed out if they didn't buy during that time. Right?
Definitely.
So same thing, I think there's parallels. Of course, this situation now is different, but I sense the same amount of fear that's again being spread through the whole industry on timing, right? So again, everyone's situation is different. You can never time, getting into escrow exactly when you want it. Of course, everyone wants to go in when rates are low.
Yeah.
But we all know if rates are low, you're probably dealing with increased competition, which means you had to bid higher to win in the first place.
Yeah,
right?
the minute like interest rates like dropped just a little bit, like last month, we started seeing a bigger influx of people. Our open houses were flooded.
Right.
But then you also start seeing more and more people get more competition again. Like houses are closing for almost close to what, at least from what I saw, 50,000 over. More than $70,000 over than listing price, asking price. But I think when now that you say interest rates are slightly going back up, every now and then you see people actually react to that and say like, oh, that quarter percentage is gonna send me away. Like I don't want to deal with that anymore. It's interesting seeing how reactive people are to that number change.
Yep.
I mean, in 2021, I was working at a call center, and people would call in and we're like, oh, the interest rate today is 2.875. They're like, no, that's too high. It was 2.75, right? 6 months later, they call in. I'm like, oh, today's rate is like 4.5. They're like, oh, wait, I thought it was 4.25. And they're like, I'm going to wait until it comes back down. And I talked to them for 2 years, right? And hey, today's rate is 6.5. They're like, oh my gosh, know? It's like you can't time the market, right?
Yeah.
If you see it, you like it, buy it, because it's something that will appreciate for the most part. Right? It's holding on to an asset that generates goes up in value. And then you can time the market with your refinance, right? And then this way, work with your lender, someone that you trust, and then this way, when you're seeing the market kind of adjust to where, hey, this kind of nice time to refinance, then that's when you pull the trigger on the refinance, right? Yeah. Because if you win it, I mean, I think for the most part, you're buying a home, you have stability, you're able to lay roots in the community, right? Because from a majority of the people I talk to, when you try to time the market, it's hard to win.
No, yeah,
you end up sitting on the sidelines longer and having the home values go up, then you being able to buy the home now and capture some of that appreciation as the home value goes up. Yeah, right. Then you sit on the sidelines for 6 months, a year. I think I was looking into some data that the person that tried to time the market for the perfect time was on average sitting on the sidelines 2.5 years longer. Yeah. So if you're talking about just, last couple of years was 5%, 20% appreciation, right? But if you just talk about the standard 3% appreciation, LA County, $800,000 home, if they wait 2 years, that's $824, and then that's like $850. The house went up $850,000. So if you would have timed it right, if you would have just bought it, you would have had that $50,000 appreciation. Yeah. The difference of interest rates probably would have been like $300.
Exactly. It doesn't matter, right? In grand scheme. That's why I always keep my calculator on me, like the Palm Agent, so that when people start like nitpicking on like interest rates or they're going on about like payments, I just run it down for them, and I'm like, this is what you were gonna pay before. This is what you're gonna pay after. Is it worth it? Like I'm pretty sure you can afford an extra like $200-300 on the sideline compared to losing $50,000 in equity in the next 2 years. Not losing, but never gaining that $50,000, potentially more in equity later on.
I think that's where a lot of people get their information from a friend, a family member, uncle and aunt that had a bad experience, right? Because maybe when they bought homes 15, 20 years ago, they dealt with someone that, wasn't as, knowledgeable. But now there's a lot of, since the crash, there's a lot of rules that have been implemented. Like we have to be really good at what we do, and there's a lot of restrictions on what we can and can't say. Right? Yeah. So there's a lot of practices in place to where, for the most part, we have to protect our clients. So a lot of that is just speak to a lender, speak to a realtor, right? Get someone knowledgeable to do a breakdown and give you the facts.
Yeah, I mean, like, again, I feel like it's so funny because I hear that all the time where it's like, oh, my friend told me this, oh, my family member told me this, but it's like, yeah, but they're not like working in our industry, you know, they're not on a daily basis like checking in on everything, you know, working with multiple variety of people to get that information. It's just what came out of one brain and one brain only, and it's like, what's to say that they're correct, you know? There's no fact saying that they're correct based off of experience or hypothesis, you know. For us, most of us, I mean, I literally saw you guys pull it up. You guys have like the data at hand for why you guys come up with these reasons. You know, you guys had your websites, you guys had the data. You watched a video before we started going on, and I'm like, wow, like these guys have it. And I was like, it just made me feel so much more like confident in knowing that, like, you know, you guys actually know what you're talking about, because, you know.
Do we though?
You tell me.
Anyone at this point is really sure, right? Which is the whole point around the whole tariff situation. I think it's such a good example of why, even with the best analysts in the world, even with the best, you know, forecasters in the world, right? They still get it wrong. You know, that's just simply the truth. There's no one that's going to be able to, despite how sharp everyone is these days, with their analysis, with the data, right? Everything just this past week, right? All the data is pointing towards, hey, mortgage rates have to fall, they're falling, right?
And they
didn't. Then we check the market, and it's not not as dramatic as all the news outlets purport it to be.
No, for sure.
Right? So.
Yeah, what I mean by like you guys knowing what you guys are talking about, it's being able to have the guts to actually be able to bring all the direct like data and all the information that you guys have gathered to literally say, it's hard to say.
Right.
You know, to literally come to a conclusion and say there's nothing right now.
Right.
It's hard for people to do that, because when people go to them with these questions, you know, especially people in our field where sales drives our lifestyle, it's like a lot of people are motivated to tell them what they want to hear.
Right.
Tell them prices aren't going anywhere, you know, or the prices are going to go down, you know, like prices are going to go up, you know. It leaves so much room for speculation, but it takes a lot for someone to really say like, hey, like, we could go anywhere. All we know is just where it's at right now, maybe what it's like tomorrow, but even then it could go either way.
Right. Again, like I said, you know, we get asked these questions almost every single week, right? Almost on the daily, where we've seen an uptick of people, you know, requesting to us, like we do know what's going to happen, right? But in reality, we need to be transparent. Our job is to educate the consumer as much as we can, right? But the decision in the end is theirs, right? Just like how we get asked a lot of float versus lock consideration advice, right? If someone is in escrow, they usually have maybe a, you know, 1-2 week period where they can decide whether or not to lock their rate. We only advise the clients on, you know, whether to secure or, hey, we do think there's a big chance that core inflation data can come back better. It should lead to better rates. You can kind of roll dice, right? But everyone's situation is different, and your risk tolerance is also different, right? Someone riding on the border of, oh, my DTI, my debt to income ratio is at the ceiling, I can't afford another $10 a month, right? If they're gonna ask us, hey, should I lock or float? What do you think our answer is gonna be?
Float.
Lock. Because because if the rate goes up, they no longer qualify for the loan, right? Versus an investor who's trying to optimize their cash flow for their property. Hey, I need my payment to be at this level, right? Or else I'm going to be negative on this property, right? So we may advise for buy downs. We may advise to wait to see where the market could go, right? They have more risk tolerance on that level, right? So again, it really depends, but we're typically risk averse. You know, we don't want to see the unfortunate things happen to the client. So we're obviously, at least in the current market, in this, you know, volatility that we see, up and down, right? Contradicting data. Who knows what's going to happen, right? We're going to advise the client on, hey, what can you grab right now, and what's the best situation for you right now, right? Not in a month, not, you know, a couple of months down the line, right? We're going to look at your assets, right? Can this person afford a buy down? If so, what amount is correct? But it's also incorrect to be obsessive over this, these rates, because I've seen clients, of course, no one can have the best rates for everyone's scenario.
Yeah,
I've seen a client leave me for an eighth, a quarter lower on rates, only for them to come back 3 weeks later saying that loan officer quoted me wrong, or they couldn't process my file, we couldn't get over these issues.
Oh, wow.
Now I only have 10 days left in my escrow, can you still help me close on time, right?
No.
So, of course, that's an important part, but again, as you know, don't stress over losing the potential deal to try to save yourself $50-$80 a month.
Yeah,
right?
it's not worth it.
Right, and the vice versa is also true. A lot of clients, who are cash strapped, maybe they only have, $5,000 left in their account after closing, right? For these clients, we maybe even advise the opposite. How about, why don't you take, slightly higher rate in exchange for us paying the majority, if not possibly all of your closing costs,
Yeah.
right? To save yourself, make sure you have, a few extra months of reserves in your account. Maybe that refrigerator breaks down in the house you just bought, right? And maybe you need a new one. You should have some emergency funds.
Yes, for sure,
Right?
definitely.
So again, it really depends. But with this market, who knows? The whole, I think, theme here is that, right, even I think with the data and information these days, how fast technology moves now, everyone thinks they're an expert, everyone thinks they know. But the truth is, there's so many, external factors that could cause a swing violently in either way on the short term, right? Yeah. So buy now if the time is right, is what we say, right? Yeah. Or if you're capable, right? No matter where the market really is, right?
Definitely. All right. Another thing I want to dive into really quickly is, before we wrap up, another thing I really want to dive into is, aside from how the market is doing, let's say there's a few things that people are trying to do. Let's say someone's, they're past the market thing. They're like, okay, I want to sell now. Let's talk about something that's a little bit more timeless, right? I've been having I'm sure you've gotten a few of these calls today, like these couple of weeks too. You said so yourself. If you've had a few agents ask you these questions, what would be a scenario where, let's say someone already owns a house right now, and they want to buy a new property. They want to downsize. They want to upsize. But they want to make it convenient for themselves. I was told that you guys have a buy before you sell kind of option.
That's correct. So we do operate our own, what we call private money division. So essentially,
Private money?
Yes.
Okay.
So private money is also known as hard money. They're interchangeable terms.
Okay.
Right?
There
it
you
just
go.
means that the money is coming from private investors rather than institution. So the guidelines, in essence, can be very flexible, where it's almost as if we make the decisions in-house. And investors, as long as they're okay with the scenario and the risk tolerance, right, then we will lend you the money. Now, in that situation that you're talking about, the buy before you sell has been very popular, as an option for, retail, at least buyers, to be able to get a property all cash. Now, as you may know, if you're a seller and you see someone coming in with all cash, 10-day close, no contingencies, that is extremely attractive offer, right?
Yeah.
So essentially what we're doing is arming our clients with the ability to do that, just that. And what we do is we'll put cross-collateralize their current house, put a lien there, give them all the cash they need to buy the home first, and then once they're able to, buy that house, the new house, they list their departing residence on the market. Once it sells, then it gets paid off, right?
Oh, so before they even list a property, they can buy the house.
Correct.
So that's good.
It depends on their situation, but usually the most common and frequent use of it is exactly that situation, right? I've seen so many clients, who's offered on 8, 10, 15 properties, right? They may be a little more conservative. They don't want to be so aggressive, but they just cannot get their offer accepted. They can't even get a counter, right? So in that client situation, we would advise that, hey, if you're tired of sitting on sidelines, you come across a property that you fits check marks everything that you're looking for, why don't you go aggressive, right? Come in with all cash offer. Let's show how serious you are to the sellers, right?
Yeah.
With no contingencies,
Yeah.
right? And 10-day close. Certainly possible with the bridge loan, right? And we take care of the hassle of, getting you that cash up front. Plus, once you sell and those liens are paid off, the buyer gets to keep all the proceeds left over, right? So transactional, is it going to be a little bit more costly? Sure, right? Because on the private lending side, there are points and extra fees there. But if it's for the sake of making sure you 100% win the bid, right, and get into escrow for that property, why would you not?
And it's convenient too. You'll have your house. You can move directly from the house that you have out. Your chances of selling that house might even be better because now you have options for staging. Go directs for your agent. It's easier for us to help you sell it when you're not living there.
Right, and you don't have to put a contingent on sale clause in your offer, which we all know sellers are going to stay away from.
They hate it, yeah.
Right.
And it creates so many problems for both deals. One of the deals that I was working on, where I was representing the buyers, the seller had that situation where she was trying to buy and hers was contingent on her sale, and that agent kept pushing me to oh, you guys need to clear out everything before they were like, we need this done now, and I'm like, no, we're not gonna rush anything for you because we still need to do our inspections. I still need to make sure this place is good. You're trying to get us to waive contingencies before we're even looking at it. And they were like, yeah, but we need the money now. We need to do earlier close. I'm like,
exactly,
we can't do that.
Right. It just leaves you and the client in such a stressful situation.
Yeah.
I've never seen it turn out 100% smoothly.
No,
right? Because there's so many moving parts. There's multiple transactions, multiple parties involved, right? Them delaying on their sale of the home delays their purchase, right, and so forth. So, but the good news is that it's not just for people who own a pre-existing home. Now, bridge loans can also be used on the acquisition, on the purchase. And how we do that is that instead of cross-collateralizing a property they already own, we can give you the hard money, the private money, along with your down payment on the new property you're going to buy. It could be a first-time home for a client. And what we do is after closing, we'll line it up for a refinance. So we'll change that hard money that you used to buy the property we'll convert it into a traditional mortgage.
After you get the property. So you only give the hard money just for the offer.
Right.
That's why I love working with you guys.
It's
you
not
guys are
just
so aggressive.
buy
I love
before
it.
you sell, right? You can just use it, even if you don't even have a property.
Yeah.
Right? You can still use that to your advantage.
Yeah.
Right? Imagine how much more competitive your offer will look to the seller, especially for those people who have gone declined, 3, 5, 10 times, unable to win, right? Because of the competition, right? There's really essentially you want to give yourself the best chance, right, to win. So. If that's a matter of you having to pay an extra 1-2% in fees, the opportunity cost of you missing out on getting that property, I would say, is much greater than the upfront fees that you pay. Right?
Yeah, and when it comes to even the buy before you sell options, I've seen it get really messy for the seller sometimes, and honestly, I think that's what I've been hearing now, one of the biggest reasons why a lot of people are reluctant to sell, because they're like, oh, where am I gonna stay until I find that new house? I don't want to live in I don't want to have to rent for a month. I don't want to
exactly.
I've seen people have to go to hotels, put all their stuff into a storage unit for a month and bring it out in order to move. I'm like, that's a hassle.
It is. I mean, if I were me, I would happily pay that 1-2% to avoid doing all of that, moving twice, right, and storing your stuff somewhere, right, rushing to get all these things done, right. There's a lot of pressure when you have a contingent on sale clause in your offer, right. So it just gets so messy, and we all know sellers these days get to demand whatever they want, right? They have the choice of buyers. So, especially coming from our history, and we have gotten so good at this, right? Where we help so many clients, win this way, right? That it's almost as if you're missing out, right? If you're just working with lender, going with nothing wrong with that, right? If you can get your offer accepted with just backed by a mortgage, which is most cases great. right?
Yeah.
You save yourself the extra fees. But for those clients who, have been sitting on the sidelines, aren't able to get into escrow, right? Why not, right?
Yeah, definitely. I think
Exactly.
it's always a great place to, great resource to have in handy, especially people who are like who really really want it. There are some people who really really want it and they don't have the right resources in order to get it. But I think
right.
that's a great way of always like throwing that towel in there, saying, here's this option, get the house,
Right.
and find creative ways to, move around it.
That's right. That's right. That's where we come in as a team, help coordinate that, make sure all the terms look good, and execution is even more important, right?
Yeah.
To help.
It's so funny because like the more I think about it, it's like, man, I feel like at this point it's the easiest for first time home buyers to move. Like they don't have to worry about selling a property,
Right.
if they just got to wait for their rent to expire.
Right.
They can even move before their rent expires and then just move everything out in one clean movement. And then now all of these pre-existing homeowners, they have to like, contingent on sale, either that or I have to save up enough in order to buy another house and then take that equity with me later on. That could take years.
Exactly. So, yeah, there are so many solutions out there, right? Which is why building the right path, forming the right strategy for each client is so important, right? It's not just, hey, what's your rate? What's your rate? Can you get it done, right? If lender doesn't care about what's going on in the back end, right, with how to help you plan out your move, right? If you're selling a home, right? These are all things that we need to consider, right, as a multi-step strategy, rather than just a single transaction. Right?
Yeah. And even if people wanted to like get into investments or anything, like if you've been owning a house and you're like, oh, I want to, start buying houses as assets and use them as investments, that's a great way of being able to like, either downsizing, upsizing in order to get yourself that kind of like property that's going to allow you to start renting stuff out, right?
Yep. Sounds like a plan.
All right. Is there anything else that I think we pretty much covered everything that we wanted to today?
Yeah. I would say, bridge loans, great topic. Not a lot of people get intimidated for sure by the sounds of it because it's
non-conventional. It's not that
high rates, high fees, but most clients overlook the fact that if we do the two-part strategy for you, we're going to help you exit out of that bridge loan. You're only going to be paying high interest for 2 months, 1 month, possibly. So your cost is actually a lot lower than you think. Right?
Yeah.
As long as we, develop that exit plan for you, make sure that you're not going to be stuck in the private loan, because that would be not a good thing either.
Yeah.
Right? When you're paying interest only. But for us, that's part of our underwriting process to examine and make sure your exit strategy out of it is foolproof.
Oh, for sure.
Right.
And again, that this always ties back down to like lender realtor relationships. It's these kind of strategies that we work together in order to fully conceptualize for these clients, make sure that they get that, perfect timing for everything. Like if I was working with another lender, man, like the times that I have, it was a pain. It was such a pain. They wouldn't pick up phone calls. All of a sudden they're on vacation. I'm like, whoa,
That's
okay.
Right. That's right.
But yeah, thank you guys again very much for coming by. If you guys want to like leave any details for people to contact you if they ever had like questions, why don't you guys just state your name, where they could contact you, and then we'll try to close it off.
James, first.
I'm James, and my number James Chan.
Well, you could drop the.
Yeah, I can put it at the bottom too. Yeah, they could give you a call anytime.
Yeah, they could give me a call anytime. You can also find me on Mustache Mortgage on Instagram.
Mustache Mortgage. Hey, are you gonna start giving us how to growth tips? I've been trying to.
I'm gonna create a reel just for how to curl your mustache.
Okay. I need to get it out first.
Yeah.
All right.
Thanks for having me. Kelly, Chao, ACG Funding. You can email, text me. If you could drop the information below.
Yeah,
I'm always open to having chats. We're always very open to any questions you might have. So hit us up.
Yeah, and then
help.
one last time, I was your host, Ethan. You can contact me at my phone number down below or at sellwithtran on Instagram or email me. next time, guys, I'll see you guys again. Bye.
See ya.